Welcome to Raise the Bar, elevated conversations around entrepreneurship, capital raising, and real estate. I'm your host, Seth Bradley. Most entrepreneurs spend their careers starting things, starting companies, starting over, starting from scratch. But there's also a different model, one where real wealth is built, and it doesn't come from grinding out organic growth day in and day out, but from big leaps, big jumps, acquiring, combining, taking businesses public. Things that most entrepreneurs didn't even know were possible for their businesses. We're talking about capital markets, M&A, agglomeration, getting small businesses access to the kind of liquidity and investor capital and growth that was previously only reserved for the big players. In the access game, how the right room, the right board seat, the right network can compress a decade of progress into months. So if you're raising capital, you're building a portfolio, or you're thinking about scaling and growth with your company, this one's really gonna open up your eyes. Let's get into it. What's up, builders? This is Raise the Bar Radio, where we talk about building wealth, raising capital, and all in all, raising the bar in your business and your life. This is the No BS podcast for capital raisers, investors, and entrepreneurs who are serious about scaling their business and living life on their own terms. I'm Seth Bradley, securities attorney, real estate investor, and entrepreneur, bringing you world-class strategies from the best in the game. If you're ready to raise more capital, close bigger deals, build a better you, and create true financial freedom, you're in the right place. Let's go. Today on Raise the Bar, we've got Callum Laing, entrepreneur, investor, capital market specialist, and partner at Unity Group. Calum has completed over 100 acquisitions, been involved in more than $500 million in shareholder value creation, taken companies public across multiple exchanges, and authored 4 best-selling business books. Very interestingly, born in New Zealand, raised in England, and now based in Singapore, Calum has built and sold businesses across multiple continents and many different industries. Calum, welcome to the show, brother.
Thanks, Seth. Looking forward to it. This is my chance to geek out on my favorite topic.
Absolutely, man. Really looking forward to this. Tell the audience where you're tuning in from.
Yeah, so based in Singapore, so it's 8 a.m. here, sunny Singapore. But we do business, in fact, I actually do very little business here in Singapore, but it's a great launch pad. So we work with companies all over the world. We use markets all over the world, and really just focus on how do we help companies connect with capital and help them scale.
Love that, man. Love that. This is a difficult question for people like us because we're entrepreneurs and we do a lot of different things. Easy for most, but not for us. But when a stranger asks you what you do on the street, what do you say?
I just run the other way.
End it before it starts.
Yeah, look, it kind of depends on who they are. So I'll try and find out a little bit more about them, and then hopefully I can kind of position myself in a way that's valuable to them. So obviously, like most of us, I've got fingers in a few pies. But generally what I tend to say is, look, I work at the intersection of capital markets and small business. And that's kind of broad enough that we can then get the conversation going in whichever direction they're interested in.
Yeah. What are you obsessed with right now, man? What's going on in your life, in your business? What are you obsessed with right now today?
This just feels like the most incredible time to be an entrepreneur. There is so much disruption happening, which I know is terrifying for most, but when you're an entrepreneur, all of the profit sits in the value differentials, and there's just so many opportunities going on right now. So Unity Group, we have kind of come up with a way to help small businesses use the capital markets. We've never seen so much deal flow. I've never seen so many deals on our table for that. I have another company called the Veblen Director Program, which helps people get their first board seats. On the flip of that, we also help businesses set up their first boards in a very low cost risk-free way, and that's one of the easiest ways to increase the valuation of a business is have a professional board on there. Again, like just absolutely inundated with the opportunities there. So, and look, AI is just having an impact on everything. And I think if you're an entrepreneur, the biggest constraint we've always had as creative people, as entrepreneurs, is the team to deliver on all of the ideas that we're constantly coming up with. And now AI can just do so much, which means that you can just launch so much quicker in so many ways. So look, I'm a kid in the candy store at the moment. This is unbelievably fun times.
It really is, man. I mean, you highlighted something that's really interesting. It's, most people are scared of change, but entrepreneurs generally embrace change. We want it. Like we love it. And I think that's what makes us feel alive, is just change and newness and, opportunities. And there's so much out there right now. And it's really interesting take that you just said where, a lot of people that are leading these companies are by their nature visionaries, and they're not great at implementing things, right? They're great at coming up with good ideas and trying to figure out, well, is that a good idea or not, is up to somebody else, and whether or not to integrate that and actually launch it, difficult to do for most visionaries. So having AI kind of back them up is an interesting thought.
Yeah, it's amazing. It's amazing.
Yeah, well, let's start off with the Unity Group, man. What's kind of your typical client, and how do you help them?
Yeah, so look, we started 10 years ago with my business partner Jeremy Harbour and myself, and we really were trying to solve our own problem, which was, you're in San Diego, so like California, tech startup, Silicon Valley, gets an enormous amount of media coverage. Venture capitalists have convinced us for years they're the smartest people in the room, despite the fact that asset class just is terrible. But they just get so much noise, and everyone gets excited about the stories because 19 kids being acquired for billions of dollars is an exciting story. But that makes up 1.4% of the economy. It's tiny. At the other end of the scale, you kind of businesses that are 200 million market cap and above, and that's kind of where private equity has played and where the capital markets really kick in. And again, lots and lots of interest in that. But then there's this massive gap in the middle. And 90% of all private sector employment sits in small businesses between those two areas. 50% of global GDP sits between those two areas. So it's the largest asset class on the planet is small businesses. And yet there's no financial product for a sophisticated investor to invest in a small business. They're too risky, they're too illiquid. So you kind of got this weird situation where there's just so much value and it's not being captured. And most of it, what we realized was that most of the people going into that space come at it from a finance background and a sort of a typical M&A approach, which is if I'm acquiring your company, I'm the smartest person in the room, so I'm going to buy your company because you're a great entrepreneur, and then I'm going to rebrand it, I'm going to tell you how to run the business, which of course us entrepreneurs, we love being told how to run our own business. That's we take that really well, especially if you're an accountant telling us how to run a business. We love that. So it just doesn't work. Like, so much value gets destroyed in typical M&A. And so we designed a model 10 years ago, which was kind of a bottom-up approach, which said, look, if you've built a multi-million-dollar, boring, cash-generating business, you're not sexy enough for venture capital, you're too small for private equity, but there's a ton of value there. So what we did was we created pubco, public-listed holding companies. We put these small businesses in. Basically, they swapped their private equity for public equity. But we left the founders in control. So operationally, they had full control. It was their brand, it was their culture, it was their hiring and firing. Nothing changed. But now they could win much bigger contracts because they were a public company. They could incentivize staff with equity, which, like actual equity, not like private company equity that you can't do anything with. And you basically became co-owners of a group. It was like a cooperative of small business owners. You didn't need to merge with any of them. You didn't need to even communicate with any of them. But you all had a vested interest in each other's success. And so that was a great product for small business owners. It's still very, very valid, works really well. The kind of the mistakes we made along the way was we designed that from the bottom up to sort out or to solve a problem for small business owners, which is how to scale. What we did on the market side, on the capital market side, is we just took best practice advice from all of these institutions which are paid to give you advice which serves them and not necessarily you. And a lot of it's, look, to give them the benefit of the doubt, a lot of capital markets advice is based on what is best practice for the biggest companies in the world. So this is what Google's doing, this is what Apple's doing, you should follow that. Great advice if you're the size of a Google or an Apple. If you're a 50 million, 100 million group of small companies, if you try and follow what the big boys are doing, you're going to get absolutely destroyed. And it's incredibly easy in the capital markets to manipulate small companies. And so we sort of played that game for a while and realized we were losing against people that had been doing this all their lives. And so a few years ago, we completely flipped the model on the head. And it started, this is a long answer, but hopefully it will be useful for your listeners. So when we were actually looking at capital markets, for a small business, it gives you credibility and it gives you a currency of this stock that you can go and do acquisitions, which is the fastest way to grow. So that's great. When I actually started to break it down and look at the last 50 years of public listings, it doesn't look very attractive. So in the last 50 years, 50% of all companies that go public end up actually destroying shareholder value. So they might have a little blip on day one, and then they go backwards and they never recover. So 50% of all public listings globally. That's a terrible metric. And it's actually got far worse. In the last 10 years, it's 68%. So nearly 70%, nearly 7 out of 10 public listings go backwards and never recover. So it's very easy to understand why. Like 50 years ago, when a company went public, it was really exciting. Like as an investor, you would phone up your broker and you would try and get hold of stock. But what else could you invest in 50 years ago? It was like real estate, government bonds, or the public markets. That was it. There was nothing else to invest in. Today, investors are just inundated. There's a million different financial products. Every man, woman, and child is raising capital for a startup. The biggest companies in the world, like the Apples and the Googles, are still growing at 25% a year and sitting on 100 billion in dry capital. And you're competing against that. Like, how do you cut through into that market? So on the buy side, there's just very little appetite for another company going public. On the sell side, you and I as entrepreneurs have been told over and over again an IPO is an exit. If you Google IPOs, it's all about how to exit via an IPO. We're kind of taught at birth as entrepreneurs that when you're talking to investors, you say, hey, we're going to exit in 3 to 5 years in the public markets. Like, it's this default line. Everyone is thinking of a listing as an exit. And so what happens is you go public, the founder tries to take money off the table, staff that have been underpaid for years try and take money off the table, all those early investors that are desperate for their cash back out try and take money off the table. So what happens, it's just basic laws of supply and demand. A company goes public, they vomit stock into a completely indifferent market, and it's no wonder the share price goes down. And the problem is, if the share price goes down 20-30%, which is very easy to do on a low liquidity new listing, then even your most loyal supporters panic and start selling as well, and you could just get into this death spiral. So that was kind of the backdrop when we actually took a step back and looked at the markets and went, well, that's not much fun. And we'd been through that a few times, and so we basically said, look, there's only 2 ways you can actually do this game sensibly, and it's ignore all of the conventional wisdom. There's no way that a normal company can create enough hype to generate more buy side than sell side. So the only other lever that you've got is to lock up the sell side. So when we take a company public now, everyone involved in the deal is locked up for 5 years. So there's very little liquidity on the market, which is counterintuitive. But actually what it means is that when somebody comes in to buy your stock, even if it's a small amount, it pushes the stock up. And you don't let stock go into the market unless there's more buy side than sell side. So completely counter. And by the way, like, there's nothing illegal about this, but the markets hate it. Investment banks hate it because they make money on transactions. Right. They want you to be constantly churning your stock. But if you do this, you can actually build really profitable, really successful groups with all of the advantages of a public company, but without any of the dealing with the volatility of a stock price bouncing around all the time. And so, yeah, that's kind of the model that we've evolved to over the years. And yeah, it's much more fun now.
Yeah, dude, that's incredible. So, tell me, like, what is the ideal company that you would take this model to? The ideal private company that's kind of just set up for this IPO.
Yeah. So look, I think when we first started this, we were really focusing on old economy, traditional businesses, cash generating, boring companies, and we're still very open to those businesses that you need to be doing to be a publicly listed company. Even as a part of a group, you really want to be doing ideally at least $1 million in EBIT, so in net profit. And it's actually for no other reason than just, well, everything stays the same about your company, your financial reporting has to be on point. That's the one really critical difference. A company that's doing maybe a couple of $100,000 in net profit probably has an office manager or a bookkeeper managing the numbers. You really need a grown-up CFO when you get into the public world. So that's one side of it. As we've kind of evolved our model, we are now much more open to companies. What's more important is kind of the growth story. So we've got a situation for the last year where we've been able to say to a company, as long as it's got a good equity growth story. What I mean by that is investors will believe you're going to be bigger tomorrow than you are today. And that could be new technology, it could be implementation of AI, it could be growth through acquisition, which has sort of been our traditional model. But as long as it's one of those and it's a convincing story, we're in a situation now where we've got enough investors that like what we do and our approach that we can fund taking a company public. So our pitch to a company is, look, if you've got a good growth story, we will pay for everything to take you public. We will run this constrained stock model. And this is a 5-year growth plan to get you to $1 billion market cap. So to add 50 million of EBIT through your organic efforts or through acquisition. But we will cover all of the costs of that. Now, we don't go out and raise tons of money for the company. We raise enough to kind of get them kicked off and started. So, $1 million, $2 million. Basically, if a company has a good growth story, then we'd love to speak to them.
Yeah, and then is your model to be ultimately invested in that company yourself? So you're taking equity and shares on that?
Exactly. Yeah. We're long-term greedy, and we align our incentives with their incentives. We want to grow this to $1 billion market cap, cross-list it onto a main market, be alongside them for the run.
Yeah, and the mindset shift here is you're looking at this IPO as a growth mechanism, not necessarily an exit mechanism, right? Because most people look at it like that.
And look, I think this in itself is pretty counterintuitive to what's happened in the markets. Hundreds of years ago, companies used to focus on legacy. Like, how do I preserve this company over multiple generations? And that's where the concept of a board came from. Like, let's put a board in place to make sure the executives don't screw up my life's work, make sure my eldest son doesn't screw up my life's work. So that's where the concept of boards came from, and telling executives no. That model has kind of gone out of fashion, and if you certainly Silicon Valley it's nobody ever talks about, hey, I want this company to still be around in 10 years. It's, I want to go from Series A to Series B to Series C to exit. Like everyone is just exit focused. I mean, Wall Street isn't much better. The longest time frame they can think of is 90 days. Nobody really talks about longevity. And yet, actually, if we go back to that 50% of GDP, most small businesses actually do care. They care about serving their clients. They care about their teams. That's why, most business owners wouldn't want to sell to private equity, even if they were big enough, because they know private equity is going to come in, kill their team, kill customer service, leverage the company with as much debt as it can saddle, and destroy your life's work. What we find is actually when you present business owners the opportunity to play a bigger game, in many cases, they're really open to that. They just didn't think that was an option. They thought it was like exit or get stuck in this job for life. And so this now becomes a fun way to grow the business again.
Yeah. So, walk me through this. So now once you've successfully had this public offering, what are the downsides, I guess, of taking these smaller companies public? And then what are the advantages? Obviously you've done it for a reason. What opportunities are now out there that you've successfully done it?
Yeah, so let's start with the advantages. It's not what people commonly think. So, excuse me. People commonly think about going public as a way to raise money. It's a very expensive way to raise money, and it comes with so many restrictions and things. There are just easier ways to raise money today. 50 years ago, sure, but not today. The advantages to me are twofold. One is credibility. Everything in business comes down to trust. And if you're a publicly listed company, it just ticks the procurement box. You can win so many bigger contracts for no other reason than you're a publicly listed company. Big companies are very risk adverse to giving big contracts to small companies. Yet if you're a PLC, it just ticks that box. You suddenly start winning bigger contracts. It's much, much easier to attract good senior team to your company if you're a PLC. Yes, you can kind of give equity, but even just aside from that, it just levels the playing field. Small businesses, it's always been nearly impossible to attract the best people. We attract who we can afford. We attract who we can get access to. But the big companies don't play that game, and so that levels the playing field. And then that third one of it gives you a currency. That stock becomes your currency. So rather than using cash to do an acquisition, you can buy your competitor, your supplier, your partners, using stock as a currency, and you can create this stock, and it's locked up as well. So it's you're not. We do all of our acquisitions are earnings per share accretive, which means you're buying them at a lower multiple than the multiple that you're trading at. So even though as a percentage you get diluted, the value of your shares go up. Now, in a small business, the percentage you own is really important. In a big business, in a publicly listed company, percentage is irrelevant. The value of the stock is what's relevant. So that's the metric that we focus on. So those are all the upsides. For somebody looking to scale, I still think it's the best model. The downsides are you're under scrutiny. There's no question. You're playing in the big leagues, and that means that there's going to be people taking shots at you. What we've done with this constrained stock model is what we realized was you take an entrepreneur that is all about creating value for others. You put them into an environment of the public markets where shareholders, they create their value for others by making profit, and they don't care whether they profit from your demise or from your success. It doesn't matter to them, and that's the culture shock that you see all the time. You see all these entrepreneurs, they take their company public, greatest day of their lives. It gets shorted, they get abused by hedge funds, they get beaten up, they take their company private again, going, I'll never do that. It's just a culture shock. It's such a surprise that people don't want you to succeed. The idea of someone shorting your stock is just an anathema to most of us. And so you're going to come under public fire. You need to get incredibly good on your numbers, or have somebody on your team that is incredibly sharp on your numbers. And look, I think what we've done is we've removed the distraction of the stock price. Every time you see a company go public where it's successful, the founder will tell you, like, you cannot keep the staff focused. They're all watching their net worth go up. Yeah. Like, it's the most, it makes Netflix look dull. It's just, it's unbelievably exciting. But in most cases, in 68% of cases, actually you're seeing your net worth go like that. And that is just as distracting and far more soul destroying for the business. And so we've taken that away with the constrained stock model. It's just a steady increasing share price. It's very boring, but it means that you can continue to do acquisitions at ever cheaper prices. And for the business, they can just focus on running the business rather than having to constantly be on the road doing investor roadshows and things. And I think this is kind of a bit that people don't really understand is, if you're successful enough as a business owner to go public, you're already spending 24/7 looking after team and clients, right? That's already more than a full-time job. Then you go public, the investors expect you to be 24/7 talking to them. Why would they give you their money unless you're going to be 100% attentive to their needs? So where does that 24/7 come from? So what we try and do is basically we manage that side and say, look, you just keep growing the business, but you're going to have an ever appreciating share price, more valuable stock to do acquisitions. And what you find as well is that you do an acquisition in your industry, the industry press will write about it, and suddenly half a dozen other companies will reach out to you and say, what's going on? Would you like to talk to us about our company? So it gets kind of progressively easier for business owners as well.
Pardon the interruption, but we don't do ads. Instead, know that if you're raising capital for real estate, my law firm, Raise Law, is here to give you the expert legal guidance you need to raise capital compliantly and structure and close your deal. And if you're looking for a done-for-you fund-to-fund solution, TribeVest is the industry's only all-in-one setup and fund administration solution. Visit raise.law and tribevest.com to learn more. Yeah. Now, is that kind of once you take one of these companies public, is that your primary growth machine is M&A at that point, acquiring other similar companies or adjacent companies as opposed to, grabbing more market share or other types of growth?
Yeah, so look, traditionally that's been our approach. We have started working with companies recently that have incredible tech stories, and they just need the public for the credibility to grow even bigger. And so for them, they're less interested in the M&A at the moment. I suspect as their revenues start to flatten, they will look at M&A like every major company does. But they've got enough organic growth runway that they can keep growing like that. So look, it's really up to the business, but you do want to be showing constant growth. I mean, look, growth is fun. Yeah. There's no question. Growth is 100% more fun than the alternative. And I think people have this idea that growing through M&A, growing through acquisition is something massively complicated. You need an army of lawyers and an army of accountants. And look, 90% of M&A transactions destroy value rather than create value. And the reason that they do is that I say, Steph, let's merge our companies, but I'm initiating this, so let's use my brand, and I'll sit above you and tell you, and we'll merge some of these companies, and we'll get these fantastic synergies. And everyone talks about synergies. Synergies are absolutely phenomenal in textbooks. They don't actually work very well in real life because nobody wants to be merged with an opposing company's department, and nobody wants to take on their new systems and processes. Like, I don't want to use your distribution channels. I've got my own distribution channels. And so that's why mergers are often so ugly. And so we just say, look, forget all that. If I'm going to acquire your company, I'm acquiring it because it's a great company. Like, you just keep doing what you're doing. Keep your brand because your clients trust you. Keep your team because it works. and you just sit underneath this holdco. So, I mean, look, Warren Buffett has been doing this for 60 years or something, or 100 years, or however old he is these days, buying companies and just leaving them alone to keep doing what they're doing. It's it's a very good strategy.
Yeah, yeah. And then what markets do you do this in? Are these, like what's the country of origin? Like, are these American-based companies that you're taking public in other countries? Are there, what does that look like?
Yeah, so I'm going to offend your American listeners here. Look, we work with English-speaking companies all over the world, and increasingly we're working with American companies that don't want to list in America. Now, I'll tell you the reason why and what we do. So basically what we do is we say, look, this is a 5-year growth plan to get you to more than $1 billion market cap. What we're going to do is we're going to list you on a tier 2 market, probably in Europe or somewhere in Asia, where nobody's going to watch you. And you can just grow quietly there. We're going to grow through acquisition, we're going to grow organically, and we're going to get you to $1 billion market cap, and then we're going to cross list back into the US, where still the majority of investors are. But once you get to $1 billion, I mean, as $1 billion market cap company, you're still tiny in the US, but you're big enough and ugly enough that you can fight your own battles. And the problem is, the US markets have been around for 200 years. Wall Street's been around for 200 years. You would have thought they're the best markets in the world. They certainly attract the most capital, but you've spent 200 years learning how to be the most litigious country on the planet, and learning how to short people, learning how to make profit out of destroying value. And so it's a really dangerous place for a small business to list. You're incredibly open to being manipulated by people that just play this game for a living. And so what we say is, look, over in Europe, you're not going to get shorted. Nobody's going to attack you. But you won't get nearly as much liquidity, but in our model you don't need the liquidity, and that's kind of the game. Get big enough that you can fight the proper battles, but do it somewhere quietly. So interestingly, we've had 2 US companies in the last few months, great companies, great growth stories. They've decided that they'll list in Europe, build it there without the headaches. And by the way, like, just in terms of cost, I'll give you an example. So we do have a US publicly listed company. We had to do a filing a couple of months ago for them. It's a 2-page filing. It cost us $90,000 to do this filing. In London, that same filing would cost about 5,000 euros. And in Frankfurt, it costs 2,000 euros. Exactly the same filing. But the US has spent 200 years perfecting how to extract money from small companies.
I'm glad I'm an attorney in the US instead of over there.
Yeah. I mean, it's crazy. You make so much money. But equally, what's happening is people are going, well, hang on, where, I think that the next generation of entrepreneurs, our clients are all over the world. Our suppliers are all over the world. And yet most people still think about listing on their home market. And actually, that doesn't make a lot of sense. Like, markets offer, there's different liquidity. There's some markets have higher premiums for some sectors than others. So when you start to take a bit more of a global approach to where you're listed, and especially if you kind of do this constrained stock model, the US is still the target market, but only when you're big enough to play with the big boys.
Nice. I love that, man. Let's switch gears a little bit and start talking about board seats. I think that's a really important topic. You've got Veblen, where you help place people into boards, probably in their zone of genius and their networking. And also you help set up first boards. So they're kind of synergistic there, but maybe just kind of where does all that kind of fit in here?
Yeah, so look, when I was a young entrepreneur, I was terrible. Like, I was a struggling entrepreneur for a long time. And I remember thinking, I wish I could sit on a board of a decent company so I could learn how this works. But I don't really know what a board was, let alone how to get on one. And then because we started doing M&A, I suddenly started finding myself on all of these boards and advising boards. And what I realized was that A, they're not nearly as smart as I thought they were. B, there's a lot of people that are on boards that probably shouldn't be on boards. They're putting their own interests ahead of the companies and the stakeholders. And C, there's a huge amount of very talented people that could never get a board seat because they looked the wrong way, they're the wrong gender, they hadn't gone to the right schools, they didn't know the secret handshakes, they didn't know the right people. And as an entrepreneur, that's really frustrating when you see talent being overlooked. And so I created Veblen Direct program 4 years ago, basically because I knew the inside of boards. I knew how you could kind of get a Trojan horse to get into those boards, because no board will ever hire a complete stranger to sit on the board. It's too important a role. So you have to build trust. So what we do is we help first timers to get board seats, mostly overseas. Like, it's easier to get a board seat overseas than it is locally. Get you onto the bottom rung of the ladder, teach you all the different ways that you can monetize that board seat. And then you can leverage up very, very quickly. Like, you can move up the ranks very quickly, but you've got to get onto that bottom rung. And that's what Veblen has done incredibly successful for about 4 years. What started to happen was companies started coming to us saying, hey, I want a Veblen trained board member. So we got to the point, we're still at this point where there's more companies want our members than we have members. And so we're at the point where if we interview someone and invite them into the program, we can guarantee them a board seat within 30 days or money back guarantee, because we've got more companies wanting us than that. And it's not just you they're buying the whole Veblen community behind you. So it's this kind of very supportive group. Now, on the other side, I was kind of going through this process. I've always had like advisory boards and stuff for my companies to grow. But actually a full proper board, it's quite intimidating for entrepreneurs, because it's a long, slow process. It's expensive to hire people, and small businesses, we need to be versatile and move. And if you bring someone on that's a great board member on day one, in a year's time they might be redundant. Like, you might have changed direction and now you're stuck with this board member. And so we created this service called Board as a Service, and it's $5,000 a month. You get 5 very well-trained Veblen board members. They've all served as chairs on at least, so they've served on 3 boards, chaired at least 1 board. Amazing backgrounds. These are very successful executives in their own right. And you just pay $5,000 a month to have them serve on your board, but you can cancel at any time and you can swap them out. So if you need capital raising skills, you bring a couple of people onto the board that have capital raising skills. Once you've raised the capital, if you now want to expand into the Middle East or Asia, you then bring on people that have that experience. So you just basically rotate this board, and it takes all of the risk away for companies. One of the stats that really blew my mind when I started looking at this was there's 330 million for-profit businesses in the world. Less than 1% of them have an active functioning board. And yet every successful company you can think of has an active functioning board. So why are we as entrepreneurs not creating boards? And it's mostly because, part of the reason we became entrepreneurs was because we didn't like people telling us what to do. And so we think a board is going to tell us what we shouldn't do. And that's not the way that we design our boards. We design our boards as growth boards. Our boards succeed when they help you grow. And the nice thing about small businesses is that one introduction, one bit of knowledge can completely change the trajectory of your business. And so our members are all trained on not what's good corporate governance for an S&P 500. Nobody cares. Our board members are trained on how can they make an introduction that can double your revenue overnight? How can they make an introduction that can get you the right investor at the right time? And that's far more valuable to small businesses than the latest ESG policies or it's all of that kind of stuff.
Yeah, you hit on something very, very interesting there. I've done it firsthand where you started a company early on. There's certain people that you meet and you're like, oh, this person is absolutely perfect. They would be great for an advisory board. Let's give them a percentage. And then like, something happens. Either one, they lose interest pretty quickly, or two, what you thought you needed isn't what you needed, and they can't really help you. And it happens all the time. And then you're stuck with them, getting these equity percentages forever, and they're just dead weight. I see it time and time again. So that's a really interesting concept. I love that, man.
Yeah. And look, I kind of have two views, because I learned this lesson with one of my early businesses. I was trying to raise capital at a $1 million valuation, and I could not get money in the door. And then I bought an advisory board on so I went and invited people. I got some great people with great backgrounds. So basically somebody from Google, somebody from Yahoo, somebody from Microsoft. Now, what their roles were less important. And what you realize, these big companies have got tens of thousands of board middle managers. I could have had the janitor for Google for all it mattered. I just had somebody from Google on my board. And suddenly I was easily able to raise money at a $10 million valuation that I couldn't at a $1 million valuation, just because I had these brands on the board. And so a board is so valuable. But I also think as entrepreneurs, not only should we have a board, even an advisory board to start with, we should also serve on boards. And every entrepreneur goes, look, I'm already too busy. I've got enough to think about with my own company. But actually, you learn so much by sitting on the board of 2 or 3 other small companies, thinking holistically about their business. There will be problems that they have solved that you're struggling with. And there will be things that you can just help them with so easily because you solved it a year ago or 2 years ago. The learning is just transformational. I'd encourage every business owner to do that. Just go and find a friend and say, hey, look, and strip away all of the theatre. People get very hung up about boards. Oh, I've got to prepare for the board meeting. Oh, I've got minutes. I've got to have a company secretary. And all. Take all of that stuff away. Just say, look, 4 or 5 of us, we're going to get together. We're going to have a coffee at the end of each month. You're going to tell us what your objectives are. We're going to hold you to the 5-year goals. We're going to hold you accountable to that. But bounce your challenges off us, bounce your opportunities off us, and we'll try and help you grow. That's immensely valuable.
Love it, man. Calum, before we wrap it up, in a parallel universe, and we all go through different pivots in our lives, and there's a lot of different moments in time where we make one decision and we could have went the other way just as easily, and things could have been different. But tell me, in a parallel universe, about a different version of you.
So, look, in an ideal world, I would be playing football for soccer.
There we go.
in the Premiership. And if it wasn't for a complete lack of talent or fitness, I think I could have done that. Look, the realistic answer is, in a parallel universe, I would still be a struggling entrepreneur. I love the challenge. I love the game. I am the first to admit that luck plays a huge part in this. I think all that's happened as I've got better at this game is I increased the surface area for luck to happen, and that has led to it kind of compounds on itself. But I'm not I'm not egotistical enough to admit that without a bit of luck, I could still be that struggling entrepreneur trying to figure out how to get the next dollar in the door. So, but I love the game. I love the challenge.
Oh yeah, man. Calum, this has been incredible, brother. Where can our listeners find out more about you?
Cool. CallumLaing.com. You can get free copies of all of my books there, and I hang out on LinkedIn. I know it's a weird place, but it's a good spot to talk about capital raising and M&A. So yeah, just hit me up there. Mention this podcast. I'll accept your connection.
All right, brother. Appreciate you. Thanks again.
Cheers, Seth.
All right, fam. That's a wrap for today's episode with Callum Laing. If this conversation made you rethink about your approach to capital markets, acquisitions, or even open your eyes up to the possibility of taking your small business public, then that's exactly what we're here for. Do me a favor, leave a rating and review on Apple Podcasts or Spotify or wherever you're listening. That's how we keep attracting operators like Calum and delivering conversations that actually raise the bar. Check out the show notes to connect with Calum, grab his books for free, and learn more about the Veblen Director Program and Unity Group. And last but not least, go to SethBradleyESQ.com, grab the Fund Founders Playbook for free to get you prepped for your next capital raise. It's free for now, but not forever, and it's going to save you thousands of dollars with your securities attorney. All right, as always, enjoy the journey and raise the bar. Thanks for tuning in to Raise the Bar Radio. If you enjoyed today's episode, make sure to subscribe, leave a review, and share it with someone who needs to hear it. Keep pushing, keep building, and keep raising the bar. Until next time, enjoy the journey.